Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to Fairport Flash. This is Katie Sheehan, Portfolio Manager at Fairport Wealth. I'm primarily responsible for assisting in the development of and implementation of our investment strategy with a focus on equities and impact investing. In the spirit of the season, with the leaves finally starting to fall here in Cleveland, we're providing you with a special Halloween edition of Fairport Flash. We're often asked what market indicators we watch in determining our strategy, and while this list is not exhaustive, it will provide a glimpse into what we think are the equity market's tricks and treats and how they're likely to impact markets as we close out 2019. So we'll start with the tricks, or some of the negative headlines that are causing some uncertainty in the market, but may not be as bad as you think. You may have heard the PMI, or the Purchasing Managers Index, fell further below 50 in September. PMI is a gauge of manufacturing, which can often be used as a leading economic indicator. When the reading falls below 50, it is considered to be in contractionary territory. While this is not necessarily ideal for the economy, our friends at Strategic Research Partners found that PMI does not have a significant impact on forward returns in the equity market. In fact, with a PMI reading of 47.8, the 3-month forward return is a positive 3.3% on average historically. So while these types of economic reports can cause some short-term noise, it doesn't appear to have a long-term effect on the S&P on its own. Now, not to be overshadowed is a high level of political uncertainty here at home and abroad. There's still issues surrounding Brexit, labor strikes in the U.S., possible impeachment for President Trump, et cetera, et cetera. List seems to continue to grow by the day, but as we've discussed in the past, global policy uncertainty actually tends to be a positive for forward equity market returns. Strategis' proprietary Global Policy Uncertainty Index is close to 350 currently, and anything over 250 has generally provided a 3-month forward return of 4.7% on average. Part of that uncertainty is in regards to the trade war with China and the potential for existing tariffs to remain in place or for further tariffs to be enforced. Worth watching, in our opinion, is the recent uptick in company bonds indicating tariffs are now having a small negative impact on sales and orders, and that's according to a survey conducted by Evercore ISI. So we'll be paying attention to management commentary during third quarter earnings season to gauge the potential for further impact on company profits, but for now, trade talks continue with not a whole lot of clarity for resolve. Next in the trick category is global growth. This has been a concern for a while for many of the reasons I provided earlier. The OECD Leading Economic Indicators Index, or LEI, is an aggregate of certain statistically significant economic data points and is relatively well correlated with global GDP with a 6-month lead. The LEI ticked higher recently, implying that there may still be some bumps in the next 6 months or so for global growth, but the downside should be relatively limited as we head further into 2020. Now, fourth quarter earnings season has officially kicked off, and as has been the case for all of 2019, analyst expectations are for negative earnings growth, around negative 2.7% for the third quarter. However, the first and second quarters of the year actually reported positive earnings growth. So while we acknowledge there have been some challenges and uncertainty for corporations this year, we're also mindful that analyst expectations historically undershoot by about 4% on average. So with that in mind, it's not inconceivable to have another quarter end up in positive territory. Additionally, even if there is one quarter of negative growth, at this point, largely expected and priced into the market, and expectations are for growth to rebound in the fourth quarter, thus implying we're not headed for an earnings recession. And the last trick I'll mention, which is only a trick because it occurred during the preparation of our podcast, is the uninversion of the Treasury yield curve. We'd like to see the spread remain in positive territory for some time before we consider it a real treat, but in the interim, it is a good sign to see. This should provide some respite, at least to some extent, from impending recession rumors. So that wraps it up for the tricks. Let's see what treats we have in store for us. First up is the U.S. consumer. Despite the headlines and the noise, consumer spending seems to remain healthy, and consumer sentiment ticked higher in the month of October. Generally, consumer sentiment will fall with some lead time before a slowdown in economic growth, so this isn't currently a significant area of concern for us. And even less concerning is the employment picture. Jobs have been growing at a fairly steady clip, especially considering where we are in the longest economic expansion in U.S. history. The unemployment rate fell to 3.5% for the month of September, with wage growth not yet showing signs of inflationary pressures. Both the consumer and employment are important economic indicators that as of now are proving supportive. Now, outside of the trade war and the daily headlines there, a lot of focus has been on what the Fed's next move will be. Will they raise interest rates again in October? Will they wait for December? Unfortunately, we don't have a crystal ball here at Fairport to know the Fed's next move, but what we do know is that the Fed seems to be easing and that trend will likely continue. That being said, in the past, when the Fed is in an easing cycle, this has boded well for the equity market. Ned Davis research found that the Dow Jones Industrial Average has returned 7.75% on average the 6 months following a third rate cut and 14.73% 1 year after. So shifting gears slightly, we consider fixed income credit spreads. Keep in mind credit spreads equate to the compensation market participants require for taking on additional risk in the form of higher bond yields. Credit spreads have widened modestly recently, and that widening generally indicates more concern in the market, but they remain well within historical averages or even lower and thus are not yet waving any red flags. Last are treats from the equity market itself. We've mentioned that seasonality does not typically favor the S&P leading up to mid-October, but now that we've crossed that threshold, historical trends point toward positive performance as we close out the year. Now, many investors will remember the pain of the fourth quarter of 2018, but we believe last year was an exception to a trend that has been exhibited for nearly 70 years. And the last piece of candy hiding at the bottom of the bucket, multiples on the S&P, that is, the valuation is measured by price to earnings, are relatively in line with a 25-year historical average of 16.2 times, implying the market is fairly valued. Now, we would note that given moderate inflation expectations and so long as earnings growth is anticipated beyond the third quarter, multiples have the potential to expand in the months ahead, in turn pushing the S&P higher. So as you've likely gleaned from the several data points I've provided today, we remain positive on the equity market as we enter the last few months of 2019. There are some areas of uncertainty and others we are keeping a mindful eye on, but that does not detract from the many treats the equity market has typically offered in this type of environment. So that's a wrap for the Halloween edition of Fairport Flash. As always, our goal at Fairport Wealth is inspiring families, and as a member of the investment team, we strive to do this through a long-term diversified approach. If you'd like to discuss any of today's general topics in more detail, please reach out to your Fairport team. Thank you for listening and be sure to tune in next month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims and make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.